Thank you, Gary, and thank you, everyone, for attending this session this morning. Very much looking forward to this panel discussion. It's intended to be a practical and, as Gary said, interactive discussion, so feel free to ask any questions as they arise. We noticed here at McCarthy's, that specialty finance was an emerging area in Canada. It's much more mature in the U.S., and thankfully we've got some U.S. perspectives as well here, so we can compare and contrast. But with the rise of fintech, and particularly non-bank lenders in Canada, specialty finance has been an area of focus increasingly as well. So really wanted to today have practical discussions about deal considerations, because obviously to these types of entities, funding is a key consideration, and how to structure those funding transactions is particular to that segment, and definitely something that is worthwhile of discussion and consideration. I will ask each panelist to introduce themselves. I think everyone here has a really interesting perspective. We've got lenders, we've got borrowers, and we've got advisors up on this panel, so we've got a variety of different perspectives. So maybe let's start with Win.
Sure. So Win Bear with Silicon Valley Bank, currently based in Boston, but soon to be moving to Toronto, actually. And so for the past several years with SVB, I've sort of helped on a cross-border basis, help grow our business up here to the point where we've finally established a Toronto office and received our lending branch license, which is an exciting step for us. Canada, generally speaking, and certainly the GTA is an incredibly exciting market for what we do, which is cater kind of specifically to a unique set of industries, innovation sector broadly, which would include, of course, tech and all the niches you would expect within tech, fintech, of course, life sciences, all the niches you would expect within there, VC and private equity firms, and then we do on the west coast of the U.S., and sadly I have nothing to do with this part of our business. We bank premium wineries on the west coast of the U.S., but so slightly different banking landscape, of course, in the States than in Canada. There's still 7,000 or 8,000 banks in the U.S. If you ranked them all by asset size, would be probably 40, 42. That's a little misleading, because after about the top 10, they drop off pretty precipitously. But we're about 56 billion in assets, so reasonably sized balance sheet, but still nimble enough to be fast moving and entrepreneurial enough for our clients' expectations. I guess my perspective in the context of this panel will be really more on the business banking side of things, specifically for companies in the innovation space. We don't really do any consumer banking. The caveat there would be what we call our private bank, which really caters specifically to partners at VC or PE firms or C-level execs at our client companies. But for the most part, you've got some better experts on the consumer lending side, but I can certainly chime in on the business lending side.
Wonderful. And congratulations on the Canadian launch.
Thanks. Thank you.
Cheryl.
Yeah, good morning, everyone. I'm Cheryl Carner. I'm also from Boston, but I am not moving to Toronto. But I do enjoy coming up here quite a bit. I've been at Crystal since 2011. We've been active in the Canadian market here since about 2012. We initially started lending in the more traditional industries. We've always done a lot in retail and consumer products and some industrials and equipment finance. And then as we started doing some specialty finance transactions in the United States, which was really incubating kind of in the 2012-2013 timeframe, we started to see some opportunities here in Canada. And one of the first companies that we worked with, and really a great poster child both for them and for us, was Easy Financial. And so we started working with them specifically to finance their unsecured consumer credit product, which was separate and distinct from their rent-to-own stores, and help them grow that portfolio over many years. And fortunately, then they were able to access the high-yield market. But we've also been very active in all different types of subsectors of specialty finance. So whether that's rent-to-own, merchant cash advance, unsecured consumer installment loans, we've looked at litigation finance and many other sectors. And so typically where we're active is in providing senior secured debt to these companies. Typically, they have some level of institutional capital that they've used to grow their portfolio to a certain level, and then they realize that they've got both enough history and enough girth to get back leverage and use debt to facilitate their growth. So in almost all instances, what we're providing is growth capital. So our minimum transaction size is 10 million, and we've underwritten or clubbed up or arranged transactions upwards of a couple $100 million. So delighted to be here. Thank you.
Wonderful. Amar.
I'm Amar Ahluwalia. I lead OnDeck Canada here. OnDeck is a phenomenal story. So we started the business back in 2007 to solve a major challenge facing small business financing. So we're the world's largest online small business lender. We've deployed more than $10 billion globally in small business loans. We're a publicly traded company. We were listed on the New York Stock Exchange back in 2014. Some of our original investors include the likes of Google Ventures, Peter Thiel, SAP Ventures as well. We were the first non-SBA lender to actually go to the securitization market in 2014 as well. So our capital stack is very mature. So institutional lenders include the likes of a BlackRock, Credit Suisse, Credit Agricole, SunTrust. We like distinct types of credit facilities that enable us to provide scale and flexibility overall. What we do really is use a wide spectrum of data, technology, and analytics that, one, enables us to provide real-time credit decisions, but also provide a best-of-breed customer experience. And all we are is about the customer. So we're engaged with the customer. We want to provide them with the most exceptional type of customer experience they'll get from the small business world. And we're able to originate in loans within 24 hours.
And as well, OnDeck had a bit of an announcement yesterday, so you can feel free to add that
So
in.
we just completed our first M&A transaction. So OnDeck Canada merged with Velocity Financial Group. We're really excited about the deal overall. It accelerates our growth in Canada, and we're looking forward to providing Canadians with a best-of-breed small business lending solution that will really propel their growth going forward.
Congratulations on that. Romit.
That's great news, Amar. I try my best not to go after Amar. And the speaking panel, but wasn't set up very nicely. Difficult to match the energy. But Romit Malhotra, I'm a partner, senior managing director at Deloitte. I lead Deloitte's investment banking business for Central Canada. It's about 80 people coast to coast, about 45 of those sit in Central Canada. Different industry focuses, but one of the key ones is specialty finance. And if you ask me, I wasn't an expert. I was a novice about 4 years ago in specialty finance. A lot of people in this room kind of learned the trade together, and that's why we all kind of know each other. And here we are. We've done 14 closed deals, just over $2 billion in total capital range for Canadian mid-market companies. Deal sizes have ranged from as small as $30 million at the low end to $1.1 billion in one case. So it's been a great story across all asset classes. I've been saying for the last 12 to 18 months that we're going to run out of issuers. But thanks to the issuer market, we haven't run out of issuers. We have 8 deals in the market, over $900 million in total capital, and I don't want that to change. Happy to be here.
Great. EJ.
Thanks, Anna. My name is DJ Lynde. I'm a partner in the financial services group here at McCarthy's in their Toronto office. My practice focuses in the financial services space. I'd say about 70% of my practice is focused in the lending space. So everything from leverage finance to corporate finance, and an emerging area that we've noticed over the last 3 years is specialty finance. So we've completed a number of specialty finance transactions over the last few years from a range of different structures, including your traditional revolving facilities and term facilities, but also some of your securitization facilities for those specialty finance companies that kind of have scaled up in the capital stack, and then also for some of the stuff in the high yield space. So we've done a number of different transactions, and I'm happy to be on the panel today.
Great. So we've got a wonderful panel, so let's dive into it. First question, what are some of the threshold questions when considering how to implement a transaction in this space? And I'll turn to Romit for this one.
Yeah, I'm happy to start. So a few things come to mind when I think about, the first ever discussion with a prospective client starts with the client. right, what their objectives are. So what are some of the key pillars? And I wrote this down because I've got a small brain, but one, I'd start with purpose, right? What's the purpose of the capital that you're trying to put together? Second would be the economics of your underlying product. What is your loan product? Are you an MCA with a 40% gross yield, or are you a home improvement lender who's fully secured with a nosy on the property, and as a result are happy getting 8.5% on your book? Third is structure, and there's a lot that goes into that. And number four would be the source of the capital, where the money's going to come from. And it's these four things have a very good amount of interplay between them. As you solve for one, the other thing moves. But I'll touch maybe a bit on that a bit more. So purpose, just in the last few months alone, it's all in the recency effect in your head as you're thinking about these things. So it could be multifold. It could be, hey, I'm looking for an adjacent funder to my existing funding that's in place. I'm looking for an inaugural institutional funder. I've been funded with LP money to date, but it's end of the day my core loan book funding. That could be one purpose. The other purpose could be I've been in business for several number of years. The funders have been a bit restrictive. I've got a lot of equity tied up in the loan book. I can extract that equity tomorrow and put it towards whatever I want, right? Haircut funding, corporate growth, whatever the case is. Third could be just getting haircut funding, right? I've matured as a business the last time I went to market, and now haircut funding can come not just from equity, but some incremental mezz capacity, right? And the last could be just corporate growth projects, not at the loan book at the funding level, but at the corporate financing level. So those are the purposes. Like that's where you start with as the issuer on what are you trying to accomplish. If you think about the next thing, which I call the product economics and cash flow, I think I should have started there actually. That's number one. We've seen clients, and we've been at times been guilty of not course correcting it quickly enough, that not every product has the same number of potential capital providers to go and seek capital from. It goes back to what I said earlier, understand your product's beauty and limitations. So if you're a 40% yielding, gross, 30% net, you've got a 10-year average term to your underlying, say, small business loan or MCA product, that's got a different capital provider market associated to it than a home improvement, 10 to 15-year term, 9% gross, 8.5 net. It's a totally different way of solving the same funding problem. The net result may be I want the next $100 million, but where it comes from is dependent on where you start in your product. Next, I'd say structure. Even I see the funders in the room here, and there's a gamut of, starting from Cheryl to Rajan, there's a gamut of, people who think in terms of SPVs being the only way to do the deal versus corporate finance, the motherhood, the corporate entity, the mothership itself would be the only way to do the deal. Within that, they'll start peeling the onion on, are we a strictly an advance rate borrowing-based type funder, or are we NPV? I'm going to discount the cash flows and get to the implied advance rate that way. So all of that, and again, I'm getting into more detail than I planned on, but these levers, the more discussion you can have openly with as a prospective issuer with your, well, one, get an advisor, right? No biases there, but have that thought, that back and forth in your head or with your advisor right up front, so that you're not spinning your wheels going to solve the wrong problem or going to the wrong capital sources to solve it.
Great. Any other perspectives, maybe from the borrower side?
Yeah, so when we look at specialty finance, we've taken a more of an institutional approach to capital markets. So definitely having a purpose-driven methodology and mandate makes a lot more sense. But we're trying to find the most optimal funding structure that enables our business to grow. And every lender is going to be different across our stack overall. So we are looking for institutional partners that provide us with the level of scale, the right credibility, the right brand, the right type of structure overall, the right type of cost of capital. And each one of those facilities is unique to the type of purpose that we're actually trying to drive. So if it's a loan book funding, it's going to look very, very different. If it's a mezzanine line, it's going to look very, very different overall. But once again, taking it all the way back, it's using that element of corporate strategy to really identify what you're trying to achieve and looking at the best type of market institutional partners available to help you execute those. So we like revolving facilities. We like SPVs. We like to have the flexibility that having a 3-year term or 4-year revolving structure overall. We like low cost of capital. We like distinct types of advance rates and unique ABS structures. We've also done a range of private transactions and whole loan sales as well. So it's really about, as a lender, having the distinct type of flexibility that enables your business to grow. So really having a diversified capital structure overall.
Yeah, I think what's interesting about what Amar said is that of all the different, I guess, data points that he's looking at when he's evaluating different financings, cost of capital was actually at the end, I noticed. And but Romit's point is accurate too, in that, for example, each lender has their own yield targets that they have to deliver and their own cost of capital. So, for example, even if I love a credit, I just can't price a deal at 5% money that Win may be able to, because we're just not structured that way. So I think that, between your advisor, and you should have one, I absolutely agree, really identifying the yield of your product and therefore what type of yield you can afford or target, I think is important. But putting that aside, all these other factors are actually, I would say, more important than the cost of capital, and being aligned with your lender in terms of ability to grow, what type of advance rates you could get, the flexibility, how that lender is going to be able to work with you, not just to get the transaction closed, but how they're going to be your financial partner post-close is also critically important. So all of those factors come into play, but I would say our cost of capital, at the end of the day, it feels like the most important, but it probably is, I don't want to say the least, but definitely not at the top.
Yeah, you could get a line at LIBOR plus 1 or 2, but if your advance rate is only 35 or 40%, you still have to go to the equity markets, or you have to go to the mezzanine markets, and your blended cost of capital might be above 12%. So that really limits your excess spread overall. So once again, it's really, as a lender, it's really important to understand what your unique strategy that you're trying to achieve, what is the tranche that you're going after, what does the yield capabilities and spread metrics look like within that specific tranche, and what provides the most amount of flexibility for your business. As originators, we're here to grow. So if you structure a facility that limits your applicability to grow, that really hinders your business. So you want to have that flexibility overall.
No, just one thing I just want to add is that you mentioned, your financial partner post-closing, but you also have to think about, if your structure includes a senior mezz component, you got to make sure your partners are able to work together. So if you're trying to put a senior institutional investor together with a mezz fund, you just have to make sure that they're able to work together. And maybe a threshold question you should hammer out early is some of the intercreditor terms about how the senior and the mezz are going to play together. Because I've seen deals where they just say customary intercreditor terms, and that's, depending if you're the senior lender or if you're the mezz lender, you'll have different views on what's customary, and the borrower is kind of the meat in the sandwich, and they're going to kind of get smacked together between the two. So I've seen deals fail over intercreditor terms not being able to come together. So I think you need to keep that in mind as part of a threshold discussion. The other thing is that you should think about just the return on investment. So if it's a term loan, thinking about what type of prepayment premiums that might need to be negotiated. I've seen borrowers not have any.
You have those? No, just.
I've seen borrowers not have that discussion with some of their lenders, and then you get to the stage where as legal counsel they say, oh yeah, we want all of our customary prepayment premiums, please put them in the document, and then the borrower sees them and they're like, what? I have to pay how much percent if I pay this early? So to Amar's point, maybe there isn't flexibility for your business, so you just have to keep that in mind. Some lenders have put that into their run rate, right? They want to know that they will get that return, so if you pay me back in year one, that you're going to make me whole for what I've been paid if the loan was out for 5 years.
If I could just add one thing, and just zooming back from big picture, as an issuer, think about your opportunity cost. When you're fine-tuning these terms upfront or during the financing process, think of if you're delaying the deal by way of going back and forth with too many funders or the selected funder, what is it costing you when you're saving that extra 30 basis points or the 2.5% extra advance rate? Could you have originated $40 million worth of underlying receivables that you're holding yourself back from? We see more and more people. It's going to all have interplay with prepayment penalties. Okay, so if that's the sticking point on a transaction that's holding it from closing, yeah, you got to fine tune that. But if you're going to win 18 months of prepayment versus 12 or 15, just weigh that at all times with your opportunity cost of what you're not funding with the money that you don't have in the tent right now.
And just to add to that, actually, so if you look at the fintech space, what makes issuers in the fintech space a bit more unique in the sense is that we're data driven. So we're able to monitor our portfolios and really understand the funding capabilities and requirements. So we can build out much more holistic strategies when it comes to long-term plans to attract that capital. So for example, like if it's 6 months down the road, I'll know today how much capital I need down the road and use the data to derive those type of estimations.
Want to keep going because we've gone through one question in half an hour, I think, but that's great discussion. But the next point I wanted to focus on is really the Canadian versus U.S. perspective. And maybe I'll throw it to Wynne and Cheryl to tackle that in terms of what's different from the Canadian and U.S. markets that you might see, and why would, for example, a Canadian fintech go to a U.S. funding source?
Sure, I can start. I mean, a couple of, maybe to overly simplify, I mean, a couple of the seemingly obvious ones are, the number of players, certainly in the U.S. versus Canada, and that's a combination of banks and non-banks, of course. Pros and cons to that. I mean, the seemingly the obvious pros are more options in the States. The seemingly obvious negative is it's really harder to weed out the chumps from a big process, really. I'm not saying we're always the greatest option either, but like it's amazing to me some of the just entities that come out of the woodwork, really more so in the States than here.
That's why you need an advisor.
That's why an advisor can help. So that's one, I would say, and this is where you get into maybe dangerous generalizations or stereotypes, but at least within our client base, in the U.S., there is historically been maybe a more aggressive appetite for taking on debt capital, and the flip side of that, because we're never looking, at least in our world, as debt as a substitute for venture capital or growth equity, et cetera. But you just, in general, you see kind of more aggressive behavior, whether it's around, on the equity side, burn rates these companies are willing to embrace. Not saying that's a great thing. It just seems to be the more the norm in the States, and therefore, some of the attitudes around debt are seemingly a bit more aggressive, both from the investor side and the company side in the States. But you're also seeing a shift in some of that behavior in the Canadian innovation space. I mean, it's very few, and the clear evidence of that is every Canadian bank is now in the technology banking space, and you're seeing folks like us come from other areas to pursue a really attractive opportunity in Canada. So you're seeing some of that mentality shift a bit in Canada and seeing more aggressive behavior. And I'd be curious to hear the other panelists' perspectives on that. Mine's, again, very much limited to kind of the companies in the innovation space.
So I would say that one of the reasons, or Wynne's right in that handful of years ago, specialty finance or fintech was one of the few industries that I would really have characterized as underbanked. And so there was a lot of opportunity both in the United States and here in Canada. While I will say that there are fewer players for this particular sector than, let's say, a widget manufacturer, I wouldn't necessarily call it underbanked anymore. And we've really seen quite a bit of price compression and spreads that we can charge, honestly, because of more options. I think that there are not very many dissimilarities between the U.S. and the Canadian market, meaning the way that we approach credit and the way that we approach our underwriting is the same for a U.S. business versus a Canadian business. Where we have to get very granular, though, about the differences is particularly on the legal diligence side and particularly the regulatory legal diligence. And especially when you're doing anything that's consumer facing. So that is a very unique aspect of specialty finance, but it does apply to both the U.S. and Canada, but it applies a little bit differently, right? So in the United States, we are looking not just at, federal laws and being concerned about the posture or tenor of the CFPB with regard to certain products within specialty finance, but then you also have to look at state regulations. It's sort of the same here, where we have to look both at the federal level and also at the province level. So that is an important aspect in transactions as it relates to the diligence that applies to both.
For sure, and that leads nicely into our next point, which was around diligence, although it sounds like there may be a bit more still on this question, but let me just... I practice in the regulatory space, so I certainly see from a diligence perspective, it is a very different thing in Canada, in the US, and even, province by province. So for example, in Canada, certain provinces have enacted high-cost lender licensing and disclosure requirements. There are different consumer protection laws provincially. There are some on the federal side that are relevant as well, including, we've seen concerns around Interest Act disclosure in some of the consumer-facing documentation, for example, or even the business lending documentation. And these areas are constantly evolving from a legal perspective and are very much kind of areas of focus for regulators. And so it really does matter that you have someone with the right expertise, including in the right jurisdiction. Unlike certain other areas where diligence may be more general, it's very particular in these types of areas. So that was an aside, but I could tell that there is still something on the last point that you wanted to get in.
I'd like to be controversial. So having worked in the fixed income markets for a long time, I think the U.S. is much more mature when it comes to specialty finance, especially around ABS. When you look at the Canadian market overall, like what is the asset class that we've traded the most over the last 20 years? Mortgage-backed securities and credit card receivables. But now the yield on those is starting to get compressed and it's starting to get thin. So as institutional investors, as you start to get more savvy and you want more yield, you're starting to look at more esoteric asset classes. Esoteric asset classes in the U.S. have been very common for a number of years. Mortgage-backed securities, CDOs, CLOs. Those asset classes are not heavily traded in Canada, but you're starting to see a bit of a changing in the guard when it comes to investor behavior overall. And online lending is one of those in the sense that it's more mature. So if you look back at the recession in 2008, the reason why the market collapsed is because nobody knew what the hell they were buying. You had blocks of CLOs and CDOs that had tranches of underlying assets that had absolutely no bearing or no understanding at all. But now if you look at the online lending segment, there's just so much more data. There's so much more data to really understand what the underlying assets are, and that is what's making the asset class so unique overall in terms of capabilities. So you're starting to see a lot more institutional investors in Canada pay a lot more attention to it. It's great to see Rajan in the room and paying attention, but it's a very exciting asset class overall, and it's definitely appealing for the Canadian market, and it will change the way that credit is overall performed in Canada and understood from a pure trading asset class point of view.
I think one of the implied question is why bother going to the U.S. market for a Canadian issuer? And yes, part of the answer is it's a deep market. Why not? But the beauty of this market is it's inefficient because it's not mature. Yes, it's getting more and more mature. It's come a long way, especially for the Canadian issuers. But what we see when we run a financing process is how differently similarly set up funds or banks would look at a credit opportunity, or the same fund would look at a similar credit opportunity differently from the way they did a month ago. So it's the inefficiency in this market versus, say, a bond market where you're negotiating on the last 5 basis points of spread, that you can gain as an issuer 100, 200 basis points or 10% of advance rate back and forth. And that keeps us excited in extracting that last bit. But Cheryl, you would not love to hear that, but that's it. Like that's what keeps us.
Give you a number of softballs to.
Yes.
And then you do that to her.
And the other thing I'd say is the U.S. funders, and this is something for the Canadian issuers in the room to take note of. They find the Canadian conservatism very refreshing. Right? When they look at the same asset class issue, like I keep talking about MCA, it's just recency effect, but the lack of stacking that happens in Canada versus the US in the MCA product, or in a consumer loan product, the amount of net yield an issuer in Canada is able to extract because there's less competition in the Canadian market as an online lender, it's very refreshing for US providers. Auto, as a non-prime auto as an asset class, it's come off the peak by a long shot in the US. I would argue we're not there yet in Canada. So if they're looking to deploy more and more capital and they're seeing the US issuers as less favorable, it's time for the Canadians to gain ground, and that's been happening.
You do anything from your end?
No.
So, on diligence, we chatted about it a little bit. Any other perspectives to offer
Do
there?
you want me to jump in from the legal and then Cheryl?
Yeah.
Jump in from the business side. So in terms of the legal diligence, I think you touched on it, Anna, a little bit, but especially for the fintech or online lenders that are consumer facing, a lot of the time we're asked to, if we're on for the lender or on for the issuer, we're asked to typically look at their consumer facing documents and actually check if they're actually complying with applicable consumer protection laws. So we'll have regulatory lawyers such as Anna look at the documentation and look to ensure that it actually is complying with consumer protection laws.
Yeah, and that's a critical point. We did a deal with a rent-to-own company, and the way they were structuring their transactions and the language in the consumer-facing documents created essentially a potential issue where counsel was concerned that there could be recharacterization risk of that particular transaction from a lease to a loan. And if that recharacterization risk were to happen, that would be pretty negative, both from the company's perspective and from the lender's perspective. So as a result of that diligence, we went back to the company and said, we can't pursue the transaction unless you're willing to both change the language on your consumer-facing documents as well as tweak your product structure and change this fee or this term or that term. So what DJ is alluding to is absolutely paramount in an underwriting and is totally unique to specialty finance because we don't really have to do this level of diligence on the, I'll call it legal business side for, let's say, a retailer or a business services company.
And so we look at the template documents. Hopefully the issuer is using template documents that are being used consistently. So we look at those, but then we do sometimes do a deeper dive depending how much diligence the client wants. And if we're creating a pool of consumer loans, the client might say, please look at the top 5 loans, or look at the they'll just do a random check, send us 6 or 7 of the completed loan documentation, and we're going to look at those, and we're going to see, are they actually completed correctly? In the residential mortgage space, it's the same thing. We'll have our real estate lawyers look at the mortgage file and see, are the real estate assets actually correct? Is the loan documentation correct? Does this issuer actually have a first priority mortgage on the real estate asset that's being included in the borrowing base for that loan? So it really depends on the level of diligence, but I'd say in the consumer space, for sure, we're looking at the documentation from a template perspective, but then, things can be good from a template perspective, but who knows if they're actually using those documents and that's what they're getting signed. The other thing that we'll look at from a diligence perspective, and it's kind of both a legal diligence but also a business diligence, is the underwriting and servicing policies of the issuer, and just making sure that how they're actually servicing and underwriting their loans makes sense, and that they're doing it in accordance with applicable law. And then from a business perspective, you want to actually check that it aligns with the financial model that you've agreed to for putting together your transaction.
So just a tip for issuers, do that diligence on yourself before, so you don't have to have a difficult conversation with your funding source at that time, because it has led to deals not going forward, and it's you don't want to spend the time and resources to go down that negotiation process only to find that you're not compliant in some way. So that's my regulatory lawyer pitch there. So maybe let's switch gears and talk more specifically about covenants. What are the type of covenants that on the lending side you're looking at?
Sure. It depends, of course, on the type of debt instrument. I mean, we've got a variety of tools just like other banks. That could range from no covenant structures all the way up to more traditional looking structures. So as far as covenants, again, we talked a little bit earlier, and again, it's related. I mean, we talked earlier about cost of capital. So your banks versus your non-banks, and the non-banks are typically going to have a higher cost of capital, and that's going to get passed on to the banks. Non-banks are bad sources of capital. They may be able to do some things structurally that the banks are not going to be willing to do, even in their most aggressive moments. So if we are going to look at covenants, typically, I think every lender will say this, but we're trying to align it at least with KPIs or metrics that are important to the board, important to the management team. Are those P&L based covenants? Are they balance sheet covenants or a covenant? And we can get a little creative with some of that stuff, as can a variety of lenders. But ultimately, however you structure them, and this is kind of just seems like lending 101, but you want to give ideally the borrower enough room for negative variance from plan, and then back to your point earlier about kind of partner reputation and who are you settling up with and how are they going to behave when things do go off the rails a bit. That's really important too. And I think in such an environment like this, and I know this will sound self-serving, but I think we'd all maybe say this to a certain degree, when you're experiencing pricing compression in an environment like this, people, and you've been in a up and to the right market for an extended period of time like this, I think people start to lose a little bit of focus on lender reputation. And I think it's, I'm not wishing a downturn on us by any stretch of the imagination, but when the next one comes, I think the quality and reputation of partner is going to be important. So that, I got off on a bit of a tangent there, but that does really tie into covenants and structure and pricing holistically.
I would say the vast majority of the transactions that we do in the specialty finance space are predicated on the underlying performance of a pool of assets. So whether it's leases or loans or whatever other construct. And so yes, P&L or balance sheet oriented covenants may be important, but what's critical to us are asset-oriented or portfolio-oriented covenants. So for example, in a rent-to-own business, they're typically trying to achieve a certain multiple on their capital, whether it might be 1.25, 1.3. And so a critical part of the diligence, we talked about the regulatory and legal side, and but we didn't really talk about the business due diligence side, and where we really spend a lot of time is with the management team in terms of their underwriting policy and procedures, but then also really looking at the historical performance of the underlying asset class and looking at it on a static curve basis and seeing how the different pools that have been originated in different periods of time perform. And we're really setting the covenants off of that. So it's both off of history as well as off of plan and sort of combining those. It is important for companies to have some wiggle room because not everything goes according to plan. And I think that there is an acceptable variance from plan where the lender is not impaired. But the reason to have the covenant is when companies really underperform, the lender needs to be at the table to figure out what's gone wrong or sideways and figure out how to address it. And I think particularly for specialty finance companies that are focused on growth, we've seen situations where companies have been so focused on growth that they've either loosened their underwriting standards in order to gain that growth, or they've gone into tangential asset classes or different products. And it's only because of the asset-oriented portfolio covenants that we were able to see and catch that things were not going as intended, and we were able to either, bring things back on track, or, the company may decide to refinance us if they want to go in a different direction and we're not comfortable with the performance. Or we've even had companies that have gone so aggressively in pursuit of growth that they essentially grew themselves into a brick wall and had to wind down their entire company. So that's why the portfolio covenants are so critical.
That we're increasingly conscious, and our clients are increasingly conscious about where we are in the cycle, in the economic cycle, that it's been 10 to 11 years of a spectacular bull run. I'm not even old enough to say this, but it's been the longest bull run of my career, right? And the Deloitte economist, the former economist of the TD Bank, talks about when there's a turn in that cycle coming, and no one's got that crystal ball, but his crystal ball says it's in the next 6 to 18 months, right? And I'm tying it back to the covenant discussion, that when that cycle turns and you're a non-bank lender, chances are you may trip a covenant or two. So it becomes important what the implication thereafter is, right? So there's increasingly a drawn negotiation in the agreements on the deals we have on the go after selecting the funder on what does a covenant trip do? Does it put you into default immediately? Or could there be a trigger event number one and trigger event number two, and the trigger event one would have some cure periods, and the trigger event two would reduce the advance rate before putting you in default, so that as an issuer, you're not immediately on the back foot. And I just want to emphasize the importance, the increasing importance of that, given where we are in the cycle. It's been too good for too long.
So I'm just going to add to that as an issuer. Actually, how many issuers are in the room right now? Just raise your hand. All right, so you got a few. Fantastic. So going back to my credit default swap trading world, so the other element to examine of this going into a cycle where economic risk actually exists is counterparty credit risk. So not only we as issuers are we're evaluated based on the type of credit that we're lending and we're originating, but the other element to examine is in a downward cycle, what does your counterparty credit risk look like for the lender of your actual facility itself? So in some cases, structure actually might be your best friend. So you want to have the right type of structure in place to ensure that you're limiting your capabilities when it comes to downfall risk in the event of a doomsday scenario such as the recession or a credit turn overall. You have seen a change in inverse yield spreads and treasury curves within the present-day marketplace. The Canadian banks, after a long time, just got downgraded. Mortgage-backed securities are starting to get very, very risky. So as an issuer, you want to ensure that your business is protected by having the right type of structure and the right type of covenants in place that enable your business to keep growing.
I feel like with all these mentions of doomsday scenarios, we have just a reminder that you can feel free to ask questions or make comments at any time. We'll leave time at the end, but certainly feel free to pipe in if you have questions on that.
The only thing I'm going to add just quickly is just two things that you typically see in especially finance transaction that you might not see in your traditional corporate finance deal is the reporting is actually more enhanced, I'd say, than like a traditional corporate finance deal. You get kind of quarterly financials and you get annual financials, and they just give a compliance certificate and say everything's good. On especially finance transaction, you can see even weekly financial reporting or monthly reporting. So that's something that's a little bit different. So just bear that in mind. It's a bit document intensive for the issuer to keep on top of that. The other thing is we're talking about the servicing and the underwriting, and that's really the importance for a lot of these deals. So you have that snapshot, day one, we've been on this business and legal diligence, but the covenants need to kind of reflect to be able to protect the lender potentially about any changes. So typically you'll have covenants around ensuring that they're not making changes to their underwriting policies without your consent, because you want to know, you've agreed to, we'll do this deal on this underwriting policy. Well, what if on day two they just change it and say they're going to underwrite a whole bunch of risky stuff that you're not in the business of doing? So that's just important. So keep that in mind.
One of the things to focus on is the types of asset classes, and they've been referenced throughout as we've been going through this panel. But I think it's relevant here to drill down a bit more, and in particular talk about what we're currently seeing. And maybe I'll throw it over to Romit to start the discussion on that point.
Yeah, so again, the market's strong. Issuers are trying to get the capital in place while it's still available. It is very much available. We're seeing unprecedented number of proposals come in when we take an opportunity to the capital provider market.
Thanks. I really thought I was the only one.
No pressure. The active asset classes, at least in Canada, this won't surprise most of you, is our auto, non-prime auto, home improvement. And when I say we've got 8 transactions in the market, totaling about $900 million, it's more than one deal in each of these asset classes. Is what driving this comment. So and then increasingly there's residential mortgages, which wasn't even on the specialty finance radar until the B20 regulation kicked in. So to state the obvious, what that has done is it's pushed that borrower who was able to walk into a bank branch and get a mortgage at 3.5% to the private lender market, who can now price, because they can, price the same mortgage at 8% plus some fees. That's changed the residential mortgage market quite remarkably, wherein those private lenders, and now we're getting inbound calls saying, we have not seen such demand since we opened shop 25 years ago. Can you find us $100 to $500 million of capital? And it can't be a Canadian source, likely not, because the banks will be caught by the same B20, because you can't do indirectly what you can't do directly, right? So it's got to be a U.S. source. So there's a real amount of activity in that space. So it's auto, home improvement, residential mortgages, point-of-sale financing has been active, reasonably active. And then there are some, I'd say and small business lenders. There's not too many of those in Canada compared to consumer lenders, but we've suddenly seen a real uptick in activity amongst, we have 3 transactions in the market, right? Which, given how many there are in Canada, that's a lot. That could be a reasonable percentage of the market, right? And then there are some esoteric classes like Cheryl, what you said, litigation financing. There's one meaningful transaction that got done, the first ever in Canada. And then that's created a bit of a momentum in the next 2 biggest companies that could become issuers, hopefully in the near term. But that's quite a wide gamut of asset classes.
Yeah, I mean, we really see a pretty wide range, although the types of subproducts or categories kind of ebb and flow. A few years ago, we saw a ton of MCA. I mean, it was literally, multiple transactions a month, people with limited or no history or track record or background, all of a sudden, within a year or 18 months establishing an MCA business. We were pretty cautious because it really did feel like sort of a gold rush and there was just too much capital chasing that sector. And there has been a lot of noise, particularly in the States, with regard to MCA and the stacking and the lack of, I'll just call it, transparency in terms of who has the rights to the cash flows. So we haven't been seeing as much as MCA, but certainly been seeing plenty of rent-to-own, lease-to-own, point-of-sale financing, different types of consumer loans, more litigation finance, a lot of small business and different types of factoring, and a lot of it has been very niche-oriented or industry-focused. We have stayed away from and will continue to stay away from because the regulatory environment is just not friendly. Payday lending. We did one transaction in subprime auto. The business wasn't really able to continue and get traction. So, we elected, or the company elected, not to continue to grow. I think that in the context of where we are in the life cycle of the market, and don't know when a downturn is coming, but it will happen at some point. And so there are some products that we're being particularly cautious, like subprime auto.
And on payday lending, I would say, certainly in Canada, there's been a lot of focus from regulators and tightening of ability to charge fees and interest. And as a result, we've certainly seen a lot of payday lenders look at other types of asset classes and start to kind of look at winding down and discontinuing possibly some of their payday lending business, given the squeeze on profits there. I'm going to try to put the panel a bit on the hot spot and try to see if anyone wants to crystal ball in terms of future asset classes, anything that either piques your interest now or you think might be coming down the pipe. And I know certainly none of you are expecting this question, and also we're on camera, so you may not want to answer it, but I thought I might as well throw it out there.
One sector that we have been looking at is the debt settlement space, and also the credit repair space, which are, both kind of interesting products. At least in the States, on the debt settlement side, there were some changes from a regulatory perspective a few years ago in terms of when a company could charge the consumer fees for facilitating a debt settlement transaction. And the shift was really from charging fees up front versus charging fees upon success. So that really did weed out a bunch of players, particularly because they couldn't navigate the working capital requirements of that. We actually have a company that is a payment processor, and so that's just, kind of direct business services, and those businesses are typically highly sought after, high margins, really easy to obtain financing, except this company focused solely on the debt settlement space. And so therein was the opportunity where there was more complexity in the transaction in order to really understand the regulatory environment of the industry that they were serving. So those are two products that we've been looking at. The litigation finance space, whether it's actually financing cases and providing working capital to law firms, or actually sort of factoring and providing an advance on a settlement. So there's sort of multiple flavors within litigation finance. We've been on a couple of transactions, haven't gotten the mandate yet, but is a space that we're spending more time in.
Anyone else wants a crystal ball?
Maybe not crystal ball, I just make a comment that got me excited last week, that there was the first time there was a asset-backed securities issue in Canada done by a non-prime issuer, which is unsecured consumer loans, rated, tranched, sold into the ABS market. To me, that opens a totally new source of capital, potentially for Canadian issuers, which did not exist. It's pretty exciting. Very exciting. It does exist. It has existed in the U.S. forever. It's a much deeper market, but that was a very exciting moment. On one side of the desk at Deloitte, somebody got excited.
So on that point, yeah, definitely. So you're going to see a lot more liquidity on the primary side and secondary liquidity created as well on the ABS market when it comes to specialty finance transactions. So across a wide range of asset classes. So you will start to see more online consumer and small business lenders go to the ABS market to reduce their cost of capital to get that more flexibility overall. And you potentially could see a secondary market created on those as well, start to be able to create to trade those on a real-time basis. The other asset class that I have been seeing more recently is the credit repair. So that's coming up more frequently. And then the other asset class that just popped up recently is bridge financing for first-time home buyers. On the down payment tranche itself, you're starting to see some more private lenders get more active in that space. And as millennial home buyers try to buy more homes and have to deal with 25% down payments, you'll see that asset class start to get a little bit bigger as well.
I thought that was the government of Canada that was bridging it.
So you actually have a bunch of private lenders doing it as well.
So we've gone a bit over time, so I want to throw it to the floor with questions.
Doomsday prep. What are you guys doing for?
It's obviously non-public information, but
Share.
well, it goes back to traditional credit behavior and monitoring. Like you need to do your sensitivities, your curve test, your convexity, really understand your portfolio. As an issuer, you need to understand your loan level data and model that out using swap curves, your credit curves overall. So it's once again, it's using that institutional capability within specialty finance to really understand your portfolio and monitor what the 12-year forward-looking projections look like for you.
Contingencies you have in place, if are in place.
Yes. We use an active approach to risk management, so we're looking at a wide range of these items overall. So if your yield to maturity within your spread market changes, that is a factor into your portfolio. You want to understand how your portfolio performs within that. If you're starting to see, for example, in the U.S., Treasury curves invert, that's an indicator that you have to be aware of. There's also a factor of that we lend to commercial businesses. So what is the debt to appetite of commercial businesses? What does the total debt exposure look like for a business overall? How does that factor into a business owner? As you start to see in Canada, a lot more consumer debt associated with your mortgages. If your mortgage rate were to be shocked upwards, what happens to your total level of debt exposure on your commercial level as well? So these are all factors that you have to play in having an advanced risk modeling capability.
I would say one of the ways that we try to, I guess, prepare is that we've talked a lot about the diligence process. We didn't really touch on the, portfolio management side. So in addition to the legal diligence, we do a field exam that would really dig into the portfolio performance metrics, among other things. And that's something that you do consistently over the life of the loan, whether it's one time a year or maybe 2 times a year, or potentially more frequently if there are concerns about either current performance with that borrower and or if you feel like there's clouds on the horizon and you have some concerns. So that's a tool that we use.
Other thing to state more the obvious is get committed funding, not less so the uncommitted route. It's always been that push and pull for issuers, and if there's a time for us as advisors to tell our clients to go for committed, it's about now. And it takes paying that extra 50 to 100 basis points of fees up front and 25 to 50 basis points of standby fee on the unused amount going forward. Good time to consider paying it. It's money well spent.
And I think the other thing on that is, I think I've seen over the last 6 months, I've seen borrowers structure their loans completely as a term loan or essentially as a ABS issuance. They've just got all the money up front instead of having to have it committed. They essentially get all the money and they can use it as they need it.
Any other questions? Gary, you seem to be holding your mic as though you.
Yeah, I'm holding my mic, but I'm mainly getting ready to congratulate the panel on a great deep dive.
Great. I'll look looks like we have no further questions. So Lynde, Cheryl, Amar, Romit, and DJ, thank you for your insights, and thank you everyone for attending.
Yeah. So I just wanted to close up things by thanking the panel again and thanking Anna for doing such a sterling job emceeing things and moderating things. And thank you again to our sponsors, McCarthy for hosting us, OnDeck and Deloitte and the rest of the panel for supporting us. I just wanted to also mention, since I have you here captive, that our next event will be June 5th at Blake's on Credit Invisibles, and that's going to be supported by TU, and PERC's going to come down from Ottawa to deliver some research there. So I think that'll be a really fascinating panel. On July 10th, we have open banking, which is obviously a huge theme for our sector being so data focused. And so open banking, that'll be at Denton's July 10th. And then we have hopefully one a month leading up until the summit. So with that, I wanted to thank everybody. It was a great panel, and I think we all learned a lot. So thanks again.